Developed by Larry Williams, the ultimate oscillator is a momentum indicator designed to capture momentum across 3 different timeframes. The multiple timeframe objective seeks to avoid the pitfalls of other oscillators. Many momentum oscillators surge at the beginning of a strong advance, only to form a bearish divergence as the advance continues. This is because they are stuck with one timeframe. The ultimate oscillator attempts to correct this fault by incorporating longer timeframes into the basic formula. The ultimate oscillator combines short-term, intermediate-term, and long-term price action into one oscillator and attempts to give overbought and oversold signals, potential buy and sell readings, and confirmations of price action, as well as divergences that might warn of future price reversals. The default settings of the ultimate oscillator is 7, 14, and 28. First, the oscillator calculates buying pressure to determine the overall direction of price action. Second, it measures buying pressure relative to the true range. This tells us the true magnitude of a gain or loss. Third, it creates averages based on the 3 timeframes involved. And fourth, it creates a weighted average of the 3 averages. By combining 3 separate time periods, short term usually 7 period, intermediate term usually 14 period, and long term usually 28 period, the ultimate oscillator tends to peak when the price peaks. The intermediate and long term also include the short term time period. Thus, the short term period is weighted more heavily in the ultimate oscillator equation. How to interpret the ultimate oscillator? Buying pressure and its relationship to the true range forms the base for the ultimate oscillator. Williams believes that the best way to measure buying pressure is simply subtracting the close from the low or the prior close, whichever of the two is the lowest. This will reflect the true magnitude of the advance and hence buying pressure. The ultimate oscillator rises when buying pressure is strong and falls when buying pressure is weak. The ultimate oscillator measures momentum for 3 distinct timeframes. The second timeframe is double compared to the first, and the third timeframe is double compared to the second. Even though the shortest timeframe carries the most weight, the longest timeframe is not ignored, which should reduce the number of false divergences. This is important because the basic buy signal is based on a bullish divergence, and the basic sell signal is based on a bearish divergence. By using the weighted average of 3 different timeframes, the indicator has less volatility and fewer trade signals compared to other oscillators that rely on a single time frame. Also, I prefer this indicator because the ultimate oscillator generates fewer divergence signals than other oscillators due to its multi-timeframe construction, so the market noise is greatly reduced. The ultimate oscillator is a range-bound indicator with a value that fluctuates between 0 and 100. Similar to the relative strength index, levels below 30 are deemed to be oversold, and levels above 70 are deemed to be overbought. Trading signals are generated when the price moves in the opposite direction as the indicator, and are based on a 3-step method. With many momentum oscillators correlating too heavily to near-term price movements, Williams developed the ultimate oscillator to incorporate multiple levels to smooth out the indicator's movements and provide a more reliable indicator of momentum with fewer false divergences. False divergences are common in oscillators that only use one time frame, because when the price increases, the oscillator increases. Even if the price continues to rise, the oscillator tends to fall, forming a divergence even though the price may still be trending strongly. Now, how to trade with the ultimate oscillator? In order for the indicator to generate a buy signal, Williams recommended a 3-step approach. First, a bullish divergence must form. This is when the price makes a lower low, but the indicator is at a higher low. Second, the first low in the divergence, the lower one, must have been below 30. This means the divergence started from oversold territory and is more likely to result in an upside price reversal. And third, the ultimate oscillator must rise above the divergence high. The divergence high is the high point between the two lows of the divergence. Williams created the same three-step method for cell signals. First, a bearish divergence must form. This is when the price makes a higher high, but the indicator is at a lower high. Second, the first high in the divergence, the higher one, must be above 70. This means the divergence started from overbought territory and is more likely to result in a downside price reversal. Third, the ultimate oscillator must drop below the divergence low. The divergence low is the low point between the two highs of the divergence. In this example, we have a classic buy signal which met all conditions. First, we have the bullish divergence forming between the indicator and the price. This means the ultimate oscillator formed a higher low as price recorded a lower low. The higher low in the oscillator shows less downside momentum. Second, the low of the bullish divergence was below 30. This is to ensure that prices are somewhat oversold or at a relative extremity. Third, the oscillator rose above the high of the bullish divergence. Now, technical analysis requires a little flexibility, and in some cases, I don't like to wait that much for the oscillator to increase above the high of the bullish divergence. An alternative entry I often use is a move above the 50 level of the ultimate oscillator. This chart shows another bullish divergence signal. The ultimate oscillator moved to oversold levels below 30 as the price fell quite aggressively. While the price moved to new lows, the indicator held above its prior low and above 30. The breakout above this high confirmed the bullish divergence signal. Also notice that we have other breakouts above resistance at a later date. Even those who missed the initial signal got a second chance as the price pulled back and again broke resistance. Let's analyze a sell signal. First, a bearish divergence forms between the indicator and price. This means the ultimate oscillator forms a lower high as price posted a higher high. The lower high in the oscillator shows less upside momentum. Second, the high of the bearish divergence is above 70. This is to ensure that prices are somewhat overbought or at a relative extremity. Third, the oscillator falls below the low of the bearish divergence to confirm a reversal. As in the case of a buy signal, if you want an earlier entry, pull the trigger when the ultimate oscillator moves below its 50 level. And here's another example. The stock surged to a new high, but the ultimate oscillator failed to confirm this high and formed a lower high. Also, notice that the indicator became overbought here. The breakout below the divergence low confirmed the bearish signal, and the price declined sharply afterwards. Now, I mentioned before that I prefer to skip the third step, the final confirmation, meaning the breakout of the divergence high or low, and use the oscillator's 50 level as entry. This approach isn't always the right decision. This example shows an unconfirmed bearish signal. First, the ultimate oscillator became overbought as the stock moved to new highs, and the indicator posted lower highs. We have a bearish divergence, but the indicator never broke its divergence low for confirmation. An entry based on the 50 level would have brought a loss, because the price reversed and continued its uptrend. So it's up to you to decide which entry you prefer. If you want to be conservative, wait for the divergence high or low to be broken. If you want a more aggressive entry, use the 50 level crossover. Here are some important observations regarding timeframes. The ultimate oscillator can be used on intraday, daily, weekly, and even monthly charts. It is sometimes necessary to adjust its settings to generate overbought and oversold readings, which are part of the buy and sell signals. Some stocks or securities may not generate overbought or oversold readings with the default settings of 7, 14, and 28. You need to increase the sensitivity with shorter timeframes. If you plot the oscillator and there are no overbought or oversold readings, you should try shortening the time frame to 4, 8, and 16 to increase sensitivity. The opposite is true for securities and stocks with high volatility. It is sometimes necessary to lengthen the time frames to reduce sensitivity and the number of signals. The ultimate oscillator, like all indicators, has its own limitations. While the multiple timeframe trading method for the indicator may help eliminate some poor trades, it also eliminates many good ones. Second, you must take into account the fact that the divergence is not present at all price reversal points. The market can reverse without any divergence. Also, a reversal won't always occur from overbought and oversold territory. Maybe the most important note is that waiting for the oscillator to move above the divergence high for a bullish divergence or below the divergence low for a bearish divergence could mean a poor entry point, as the price may have already run significantly in the reversal direction. That's why I told you I try to skip this step and enter earlier in my trades. So, as with all indicators, the ultimate oscillator shouldn't be used in isolation, but rather as a part of a complete trading plan. And such a plan must include other forms of analysis, such as price action, other technical indicators, and even fundamental analysis. If you found value and learned something new, leave us a like to show your support, and make sure you subscribe and click the bell icon to stay notified when we release new videos. Until next time.